everyone, and welcome back to my channel. Today we're diving into a topic that's important to everyone, but sometimes feels a little bit confusing. Inheritance tax is essentially a tax levied on the estate. That's the total value of things you own, like property, money, and possessions, when you pass away. The good news is there's usually no tax to pay as long as your estate is below £325,000. You're good to go. If you leave everything above that to specific people, this includes your spouse, civil partner, a registered charity, or a community sports club. But even if your estate is below the threshold, you might still need to report its value. If you gift your home to your children or grandchildren, including adopted, foster, or stepchildren, your threshold can actually increase to £500,000. If you're married or in a civil partnership and your combined estate is below your individual threshold, the unused amount from one partner can be added to the others after you pass away. The standard rate for inheritance tax is 40%, but it only applies to the amount exceeding your threshold. For example, let's say your estate is worth £500,000 and your threshold is £325,000. You'd only pay tax on the remaining £175,000, so the tax would be 40% of that amount. If you leave 10% or more of your net estate, your total value minus debts, to charity, your estate may qualify for a reduced tax rate of 36%. Gifts you give while alive might be subject to tax after your death. However, depending on when you gave the gift, something called taper relief could reduce the tax burden. There are also other exemptions like business relief, which allows certain assets to be passed on with little to no tax. But these are complex. Who pays the tax? The funds from your estate are used to pay inheritance tax to HMRC. This responsibility falls on the person handling your estate, usually called the executor if you have a will. Your beneficiaries typically don't pay tax on what they inherit, however they might have to pay related taxes on income generated from those assets like rental income from a house. People you gift things to might need to pay inheritance tax, but only if the total value exceeds £325,000 and you die within 7 years of giving the gift. The good news? If you're married or in a civil partnership, you can leave your home to your spouse without any inheritance tax. That means you can rest assured that your loved one will inherit the house without any additional financial burden. If you're planning to leave your home to someone outside your spouse or civil partnership, things get a bit more complex. Here's what you need to know. The value of your home will be counted towards the total value of your estate for inheritance tax purposes. However, you can potentially increase the tax-free threshold to £500,000 if you leave your home to your children, including adopted, foster and stepchildren, or grandchildren. But there's a catch. Your entire estate must be worth less than £2 million to qualify. Now, what if you want to transfer ownership of your home before you pass away? Here are some things to consider. If you give away your home and live for another 7 years, your beneficiaries won't have to pay inheritance tax on it. If you want to continue living in the house after giving it away, you'll need to do several things. Pay rent to the new owner at a fair market rate. So that's similar to what other renters in the area pay. Contribute towards shared bills, and live there for at least 7 years. Gifts with reservation. This is important. If you give away your home but keep living in it without paying rent or contributing to bills, it's considered a gift with reservation. This means the house will still be counted towards your estate for inheritance tax purposes. There are some exceptions to the rent and bill requirements. If you only give away part of your property and the new owners also live there, you don't have to pay rent. If you die within 7 years of giving away your home, the 7-year rule still applies to regular gifts, but not to gifts with reservation, which will be taxed. It's important to remember that inheritance tax might apply to some gifts you give while you're alive. Whether or not tax is due depends on several factors. So let's break it down. What counts as a gift? Anything you give away falls under the gift umbrella, including money, such as cash, cheques and bank transfers. Belongings, so furniture, jewellery, antiques and vehicles, and property, houses, land and buildings. Also investments, stocks, shares and unlisted shares held for less than 2 years before your death. Gifts don't include anything left in your will, part of your estate, gifts between spouses or civil partners up to certain limits, or donations to charities or political parties. Each year you have a few ways to give tax-free. An annual exemption. Give away £3,000 total per year. Any unused allowance can be carried forward for 1 year. The small gift allowance. Give up to £250 to multiple people per year, excluding the recipient of other allowances. Wedding or civil partnership gifts. give tax-free depending on the relationship. £5,000 to children, £2,500 to grandchildren and great-grandchildren, or £1,000 to others. You can make regular affordable payments for someone's living costs, such as rent and child savings, tax-free as long as it's from your regular income. Gifts are generally tax-free if you live 7 years after giving them. If you die within 7 years, gifts in the last 3 years are taxed at 40%, and gifts from 3 to 7 years ago have a sliding tax rate called taper relief. This only applies if total gifts in the 7 years exceed £325,000. If you give something away but still benefit from it, such as letting someone live in your gifted house, it counts towards your estate's value and could be taxed. It's crucial to keep records of gifts you give in the 7 years before your death, including what was given and to whom, the value of the gift, and the date of the gift. Usually your estate pays any inheritance tax on gifts. However, if you give away more than £325,000 in gifts within 7 years of your death, the recipient might have to pay tax on their portion. If you're not a UK resident but you have assets in the UK, like property or bank accounts, there's a chance you might be hit with inheritance tax when you pass away. But here's the good news. It doesn't apply to everything. You're exempt from inheritance tax on the following: foreign currency accounts. This includes your savings at the bank or post office outside the UK. Overseas pensions. Your retirement nest egg from another country is safe. And certain investments. Holdings in certain types of investment trusts are also exempt. Now, things get a bit more complex with assets like trusts, government bonds, or if you're part of the visiting armed forces. For these situations, the rules differ, so it's best to check with the HMRC Inheritance Tax Helpline for specific advice. But wait, there's more. Just because you live abroad, it doesn't automatically mean you're exempt from inheritance tax. HMRC might consider you domiciled in the UK for tax purposes if you lived in the UK for 15 out of the last 20 years, or if you had your permanent home in the UK within the last 3 years of your life. Lastly, don't forget about double taxation treaties. These agreements between countries can help your executor claim back any tax you might end up paying in both the UK and your country of residence. Inheritance tax can be a tricky subject, but hopefully this video has given you a basic understanding of inheritance tax and how it applies. Remember, for specific details and personalised advice, it's always best to consult with a professional advisor.